So now that we understand a down payment and the necessary requirements that we have to take to come up with the funds for a purchase transaction, it's important to understand what the other party, or in this example, the mortgage lender, is going to be looking for before they lend us the money. We're going to start this section by talking about our credit scores. Most people understand that a credit score is going to be one of the determining factors before a mortgage lender or any type of lender is going to facilitate or lend us money. So let's talk about what makes up a credit score and how these scores are calculated. Before we jump in, it's important to understand that a mortgage lender uses the strictest algorithm when generating your credit score. So typically what you're going to see is a discrepancy from what you see every day as your credit score to what the lender generates as your actual credit score, which is going to determine not only what loan programs you qualify for, but also the interest rate and your mortgage terms as well. So let's jump into, again, what generates this credit score and what weighted factors go in to your credit score. By far, the most important thing when it comes to your credit score is your payment history. A perfect credit profile has all on-time payments. This doesn't mean necessarily that you're paying off the entire balance every month, although that is a great thing. It means that you have zero late payments, that at least every month, month in and month out, you're making the minimum credit score, or the minimum payment. Next is your credit utilization. This is factored in as 30% of your weighted score. It is very important to maintain very low balances while having very high credit lines or credit limits. So for example, if you have a $1,000 credit line and you have $500 only outstanding, you have a 50% utilization rate, which is not good. Ideally, all of your utilization rates should always stay underneath 30%. If they are under 20%, it reflects as a positive to your credit score. Anything over 50% starts to actually report as a negative to your credit score. So you'll be doing damage to a certain extent to your credit score. Next is your credit length. Banks and lenders want to see that not only do you have a great history of making payments on time, but that you have a long history of being a good borrower as well. So the older your oldest credit line is, the better for your credit score. A little tip: never close out old accounts or old credit cards unless it's absolutely necessary, as this is an easy way to increase your credit score if your trade lines are dated older and older. Next is your credit mix. This is only factored in as 10% of your score, but lenders want to see that you can handle a variety of different loans and debts, including, but not limited to, just credit cards, which is considered a revolving debt, installment debt, such as car loans or student loans, and then of course, mortgage loans or personal loans. A good credit profile has a good mix of different trade lines altogether. Last but not least is our inquiries. This will again have a weighted factor of about 10%, generally speaking, when it comes to your credit score. Lenders and banks don't want to see a whole lot of inquiries. So it's best if we avoid taking out too many credit cards at once, or opening up too many trade lines at once, or getting too many inquiries on our credit report at one time. This will slightly decrease your score, but the good thing about inquiries is they're the quickest to recover. Meaning if you have a couple inquiries because you're shopping around for a credit card, you're going to see an initial dip in your credit score over the next, call it 60 or 90 days. But in 6 months or a year, your credit's going to be fully back to normal and probably higher because you opened up a new trade line. So, how high is your credit score? Do you know your mortgage score? If not, the easiest way to find out your exact credit score is simply to apply with a mortgage lender. Mortgage lenders will typically use your median credit score. That's the middle score reporting from all 3 major credit bureaus. If your credit score is below 660, you should immediately address your credit and try to bring that score up, ideally above 700. At 660 or below, most of the time you're going to be flat out denied for most loan options. And of course, if you do qualify for any loan options, you're going to take a significant hit to your interest rate. Your credit score is very important. And sometimes it's easy to manipulate. So if you need that extra assistance, use your mortgage lender or reach out to a professional to help you. A quick story comes to mind for one of our students. We had been working with him for about 6 months, and he was aggressively addressing his credit. He had gone up from 630 all the way to 695, but he couldn't get over the hump to go over 700. So he asked us to look at his credit report, and we noticed one credit card. For some reason, that utilization was sitting at about 55 or 60%, which was negatively impacting his score. We told him to pay it down below 15% and to give it a month or two. 1 month later, his score had shot up. This means that he effectively moved 3 brackets when it comes to his interest rate. So this a lot of the time has a bigger impact than most of us will really assume. Let's look at the table that we've prepared for you to get a better feel for where our credit score might land. If you're below 580, this is considered very poor credit. You're going to be almost completely ineligible for any types of loans. From 580 to 620, this is still considered poor credit. However, there are government loan programs that you may qualify for, but again, you're going to take a significant hit to your interest rate. From 620 to 660, you're going to have limited options. This is considered not great credit, but at least you're going to have a few different options when it comes to your loan programs, although again, you'll be taking a hit to your interest rate. From 660 to call it 700, this is fair credit. You're going to have all the options available to you, but they're not going to be great interest rate options. From 700 to 740, this is considered good credit. All of your loan options will be there, and you should be able to get a solid interest rate. And 740 plus, you're considered to have top tier credit. This is going to give you the most options available and the best interest rates available. So let's talk about the difference between a hard credit check and a soft credit check when it comes to applying with mortgage lenders. For 90% of us, a soft credit check will do for the application process. The only times you really want to engage with a lender that wants to do a hard credit check is if you have credit that you're trying to actively work on or you're trying to reach the next tier. So if your credit needs to be boosted and the lender does a hard credit check, they will have access to information directly from the credit bureaus. And the credit bureaus will tell the lender exactly what the consumer or you need to do to hit the next credit tier or to improve your credit overall. Just be careful, because some lenders out there will tell you that they have to do a hard credit check on your credit profile. So just be wary if this comes up, because a lot of lenders use this tactic to try to convince you to only work with them and limit your options to shop around for a lender once you actually do go under contract. Let's go through some of the pros and cons when it comes to soft checks and hard checks. So when it comes to generating all 3 credit scores, a hard check does the trick, and so does a soft check. For all mortgage lenders and most loan products, the lender is going to use the median score or the middle score generated from the 3 major bureaus, Experian, Equifax, and TransUnion. Next, let's talk about the details. So a hard credit check is going to provide all the details and the lines of credit, the payment history, and all delinquencies. If you have a lot of delinquencies or you've missed a lot of payments, a hard check is probably in your best interest, because sometimes a soft credit check will not report all of the delinquencies. If this could be a major issue, if you go under contract and the lender doesn't have a record of a delinquency, and then it comes up once you're actually under contract and your money is at risk. When it comes to the ability to negatively impact your credit score, a soft check will not impact your credit score. A hard check will have a negative impact on your credit score because it will be registered as an inquiry. Again, we've already touched on it, but feeling locked into a lender. A soft check is non-committal. A hard credit check registers as an inquiry, so you want to typically do hard checks together with 2 to 3 lenders during the same time frame or the same 30-day window. It's required if you need to know exactly how to increase your score quickly. Again, hard check will give that to you, a soft check will not. And then again, for higher credit scores, go with a soft check. A lower credit score, it may be in your best interest to do a hard credit check. If you have questions about what a lender is telling you when it comes to a soft check versus a hard credit check, you can always use our chat function and ask us questions directly. We'll give you the best honest advice that we can. We've also prepared for you in this class a very easy to use roadmap when it comes to deciding whether or not you should do a soft check or a hard check. All you have to do is follow the map and it'll tell you what's in your best interest. So let's look at an example together. So that way you get a better feel for exactly how your credit score impacts your interest rate and the terms that are offered from mortgage lenders in general. I've prepared two different examples for you, and they're almost identical. However, the one on the left has a credit score of 750, and the one on the right has a credit score of 680. Both loan types are 30-year fixed mortgages on conventional loans. However, if you pay attention to the interest rate, the one with a 750 credit score is generating an interest rate of 6.5%. The one on the right with a 680 credit score is generating an interest rate of 7.375%. That is almost a full point difference and nearly $250 extra every single month in interest alone just because of the discrepancy in credit score. Now, let's focus on the monthly private mortgage insurance, which is required on conventional loans if we do less than 20% down, like most first-time homebuyers do. So if we look at the 750 credit score, it's $65 per month. If you look on the right with a 680 credit score, that same monthly private mortgage insurance balloons to $180. That is a total monthly discrepancy of nearly $350 per month, which equates to nearly $4,000 in extra expenses for the individual with a 680 credit score. In addition to that, the person with a 650 credit score isn't going to be able to qualify for the best products or down payment assistance programs like we talked about earlier in the class. So let's finish up on credit by reviewing how we maintain the highest score possible or how we start pushing our credit into the right direction. So again, we want to lower our credit utilization. The fastest way to get the highest score possible is to just eliminate the amount of debt that we're carrying month over month. Remember, it's key to keep your utilization rates below 30%. If you have any derogatories or late payments, it's very important to quickly come up with a resolution to these issues. So that starts with asking for forgiveness from any debtors or creditors. So if we're having an issue we can't make a payment, get on the phone with the bank before we miss a payment or right after we miss a payment. A lot of the times, banks and creditors are going to figure out a solution that's hopefully not as detrimental as having late payments on our credit profiles. Let's make sure that we always take advantage of increased credit limits. So if a bank asks you if you want to increase your limit with them, your answer should simply always be yes. This doesn't mean that you want to go out and request or necessarily ask for an increase in these lines of credits. If you do that every couple of years, that's fine. But typically, if you ask for an increase in your credit limit, it's going to impact your score in the form of an inquiry. If they ask you if you want to increase your credit limit, typically this does not require a hard credit check, and it's an easy way to boost your credit. Remember, having different loan types and having a good mix of different loan types on your credit profile is very important. So installment loans, revolving loans, and mortgages are all ways to boost your credit scores over time. And then remember, having a long established history of on-time payments is the best way to impact your credit score. So keep your trade lines open at all times, don't close out your credit cards, and just keep letting that good history pile up. And remember, there are easy ways to hurt your credit profile. So let's make sure we're avoiding those at all costs. So let's avoid any late payments or derogatory accounts, including medical debts. Let's make sure we avoid maxing out our credit card or not paying down our credit card on a regular basis. And then, of course, let's make sure we're not opening up too many lines of credit at the same time or making too many inquiries at the same time, because this will have a derogatory impact on your credit. Hopefully you found this section to be helpful, and as always, you can message us any questions you have about credit directly.